Hello, this is Collier with Make Your Money Work for You, and welcome back. This is the second part of week 2, protecting your investment. In this training, we're going to do a deep dive into money management and risk management. Now, the goal of this training is to teach you the differences between money management and risk management and how to use both effectively in your trading strategy. When we talk about money management, we're talking about your entire portfolio. You have to know how much money you can invest in any one particular stock based on the size of your entire portfolio. Money management will also dictate how much money you can risk in that one trade. Risk management, on the other hand, quantifies the managing of the risk in each individual trade. You will determine the price to enter the trade, where your sell target is, and what your stop loss is should you be wrong about the direction of the trade. It's important that you clearly understand why money management and risk management are so important. When you lose money in the stock market, it is a harder fight to just get back to even. For example, if you lose 20%, it takes gaining 25% just to get back even. If you lose 30%, it takes 43% to get back even. If you lose 50%, it takes a 100% gain just to get back even. If you lose 60%, you will need to make a 150% gain just to get back even. The moral of the story, don't lose. And when you do, cut your losses early. Warren Buffett said this: rule number 1, never lose money. Rule number 2, never forget rule number 1. Need I say more? I'm going to drill this into your head. Cash management. What we're going to talk about is the 10-1 rule. The 10-1 rule means not to invest more than 10% of your portfolio into any one trade, and then don't risk more than 1% of your total portfolio. So for example, if you had $100,000, you would invest no more than $10,000 in any one trade. You would also risk no more than $1,000 in that trade, which represents a 1% loss of your total portfolio amount. Now, I want you to learn this rule and stick with it. You must learn how to manage your account. Over time, you will have to rebalance your account as your portfolio grows. Beginner investors usually have smaller accounts and cannot apply this principle. Small accounts. Smaller accounts struggle with the 10-1 rule. A better approach for a small account is to be an investor and to use the buy and hold strategy and build your position. Build your position until you have enough money to trade and implement the 10-1 rule. In the beginning, you must build your portfolio. Invest in solid companies that are growing and will stand the test of time. Do not invest in speculative stocks at this time as a beginner. We covered what speculative stocks were in week number 1. Think like a poker player. Money management is all about strategy. The best analogy is poker. You would never push all your chips in at the beginning of a poker game. The winner in the game of poker never wins every hand. However, they play well enough to win more than they lose. They know when to hold and they know when to fold. Small accounts take the most risk in the early days of trading. Your key focus should be on building your position. These are a set of money management rules. Here's your goal. Build to the 10-1 rule. Do not invest more than 10% of your portfolio in any one trade. Do not risk more than 1% of your total portfolio. Again, we gave the example of a $100,000 portfolio. That would be no more than $10,000 in any trade, no more than $1,000 loss in that trade. That's your risk tolerance. If you have a smaller account, you might try using a 22 rule or a 25 rule. Here's what that example would look like. If you've got a $1,000 portfolio, no more than $200 in any trade, no more than $20 loss in that trade, and no more than a $50 loss if you did the 25 rule. But this is very, very difficult to do, again, with a very small trading account. Money management rules continue. Liquidity. Do not invest all your cash. Keep 20 to 25% of your cash liquid. Active trades. Limit active trades to 5 to 7 trades at any given time. New investors should limit their trades to 1 to 3. Reward risk ratio. Only invest if there's a 3-to-1 reward risk ratio. We will cover that later in this training. Protection. Use limit orders to get in stock and stop loss orders to protect. Exit. Get out of the stock when the stock price hits your goal. Strategy. Know your entry, your exit, and risk tolerance before even taking the trade. Funding. Keep putting money in your account to reduce your risk and build your portfolio. Alternative. Use a buy-hold strategy until you have a sizable account. Probability. Understand that it is possible to lose 10 trades in a row, which is why we implement the money management and risk management rules. Once you have established your trading rules, never, ever deviate from them. Never second guess them. Stick firm to your rules or you will suffer. How to protect your investment. In order to protect your investment, you need to learn a couple of rules to investing. You must learn how to master your emotions. Read the book, Trading in the Zone. It will help tremendously. There are 4 main emotions that you will feel when you start trading in the stock market. FOMO, fear of missing out. Inevitably, there will be a stock that takes off before you had a chance to buy it. It's called missing the bus. Some investors will panic and chase the stock, paying a higher price for the stock only to see the stock decline. Overconfidence. If you are fortunate, you will experience a winning streak in the stock market. It will seem as if every stock you choose wins. You will be cautious at first, and when you win, your mind will start thinking about how much you would have made if you had just invested more. Don't fall for this mind trap. You are never as good as you think. Defeat. Some people are gun shy, and as soon as they invest their money, if the stock drops 1%, they get out of the stock. Stocks trade in a range, and sometimes there are pullbacks. You will have red days. You will have red weeks, and maybe even red months. But if you've done your homework and chosen great companies, you will need to learn to be patient and hold them. Greed. This is the exact opposite of defeat. You may have a stock that keeps growing and passes what you initially thought it could do. Your mind will tell you to keep holding just to get a few more gains, only to watch you lose all those gains that you had. These are the 4 main emotions that you will feel when you start trading in the stock market. Getting in the trade. When buying a stock, you should go into the purchase already knowing your exit strategy based on best case scenario and worst case scenario. The problem with most people is that they're investing with no knowledge of what is going on and no strategy. We're going to talk about risk reward ratios. You should never invest in a stock that has less than a 3-to-1 risk-reward ratio. That means that for every dollar you risk, the trade has a potential to gain $3. There are several strategies that we will discuss later in the course to assist you with determining the numbers that calculate our risk-reward ratio. But for now, we can use support and resistance numbers or 30-day high and 30-day low numbers. My preference is monitoring the Bollinger Bands, which we will discuss in week 4. This chart is being pulled from the website finviz.com. We are using support and resistance lines. You can see the support is $20 while the resistance is $26. The current price of the stock is $22. To determine if this stock has a 3-to-1 risk reward or better, we will need to calculate the reward and risk numbers. The reward is the selling price minus the entry price. If the selling price is $26 and the current price is $22, then the reward would be $4. Next, we determine the risk. Risk is the entry price minus our stop loss, which is the support. The entry price is $22 minus the stop price, which is $20. This gives us a risk of $2. To determine ratio, we divide the reward by the risk. In this case, 4 divided by 2, which gives us a ratio of 2. This is a 2-to-1 ratio. It is not a trade that we would want to enter. Now, timing is everything in the stock market. We can look at this same stock and change some parameters and use our limit commands to put together a trade that would execute if our numbers are met. In this scenario, we keep our sell price at $26. We change our stop loss to $19 and change our entry price to $20. The reward would be $26 minus $20, which equals $6. The risk would be $20 minus $19, which equals $1. The ratio would be 6 divided by 1, which equals 6. Our ratio would be a 6-to-1 ratio, which would be better than 3-to-1 and worthwhile for the trade. Let's look at a more expensive stock. The sell price is $102. The stop price is $83. We set a buy limit order of $87, which is our entry price. The reward is $102 minus $87, which is $15. The risk is $87 minus $83, which is $4. We take the reward, which is $15, and divide it by the risk, which is $4, and it gives us 3.75 as our ratio. This is a 3-to-1 ratio, and it works. Let's work out how the last example of an $87 stock with a $4 risk and a $15 reward would work out on a $100,000 portfolio. If you had a $100,000 portfolio and you applied the 10-1 rule, you would invest no more than $10,000 in any investment. You would also only risk $1,000 in that investment. Being that we can only risk a total of $1,000, we can determine the number of shares that we can buy. If we have a $4 risk, we divide $1,000 by $4, which gives us a maximum of 250 shares that we can purchase. However, there's a problem. 250 shares times $87, which is the cost of the stock, is $21,750. We cannot spend that much because we are limited to spending only $10,000 on any one investment. So to determine the maximum shares we can buy, we now have to divide $10,000 by $87, which is the price of the share, which gives us 114 shares. If we make this trade, the money we risk is 114 shares times $4, which is $456. The potential gain on this trade is 114 shares times $15, which is $1,710. Now, I'm sure the math is not crystal clear to you yet. Please review that last example over and over until it crystallizes. Use the Facebook group to ask questions. Watch the videos multiple times to allow it to sink in. And finally, congratulations. You made it through week number 2. Protect your investment.